Look, hedge fund shorts have really capitulated when it comes to front-end interest rates. They really don't believe what Powell told us or what Bullard mentioned yesterday. And the extent to which this positioning has been unwound was so quick. You can see this red dot here. That is the extent of the short positioning we got to when Powell was mentioning that 50 basis points was back on the table in terms of their rate hike pace. How quickly that was wiped out just as the SVB collapse happened. And we're now pricing in 50 basis points of rate cuts at the end of the year. But I'll tell you why, Matt. There are some people out there in the market that will argue that the regional banking woes do not end until the Fed cuts rates. They cannot be competitive with money markets yielding 4 to 5%, and they cannot be competitive when it comes to holding on to their deposits, nor does their business model make sense when the yield curve is this inverted. That is not fixed until the Fed cuts. But given this front-end positioning turned around so quick, it would be prudent of us to discuss how quickly could this short-end positioning come back? How quickly could that short positioning in Treasuries come back? I'll paint you a picture using the rest of this week's data. Jobless claims comes in tight. The Fed's balance sheet data we get on Thursday shows that the new lending facility had little take-up. Maybe some of those regional banks were bold enough to pay some of that liquidity back. PCE on Friday comes in hot, especially in those super core measures. And finally, Friday after the close, that deposit data we get from the Fed, maybe it shows inflows into U.S. Small banks. That would be the scenario that would lead us to believe that the Treasury shorts could come roaring back, and maybe we'll believe Powell when he mentions that cuts are not on the table.